I can ignite the world with a single match, and I can burn it down with a single bond. In the autumn of 1929, as speculative frenzy on Wall Street reached its peak, Ivar Kreuger, the match king, who controlled 2/3 of global match production, sat in his lavish office overlooking Manhattan and uttered these words to his assistant. He could not have foreseen that this would become the most fitting epitaph for the business empire he had so meticulously constructed. Welcome to Finance Traveler, where we explore the epic stories of money, power, and capital across time. The story we unravel today ultimately culminated in one of the 20th century's most audacious financial frauds, the aftershocks of which still reverberate through global capital markets. Our story begins in the late 19th century, when matches were still hazardous goods. Early yellow phosphorus matches were prone to spontaneous combustion and highly toxic, condemning factory workers to the ravages of phossy jaw, a gruesome occupational disease that caused necrosis of the jawbone. The turning point came in 1844, when Swedish chemist Gustav Erik Pasch invented the safety match. His innovation separated potassium chlorate from sulfur, moving the striking surface to the side of the matchbox. This seemingly simple technological breakthrough solved the problem of spontaneous combustion, significantly reduced toxicity, and transformed matches from dangerous goods into safe everyday items, becoming the cornerstone of Swedish industry. Ivar Kreuger, a young engineer and shrewd businessman armed with a degree from the Royal Institute of Technology in Stockholm, saw opportunities far beyond mere technology. His creed was clear and ruthless: control the patent, and you control the entire industry. In 1907, Kreuger acquired the core patents for Swedish safety matches. But his true ambition extended far beyond match manufacturing. He viewed these humble wooden sticks as mere leverage, a gateway to acquiring something far more valuable: state-granted monopoly concessions. In 1913, he founded Svenska Tändsticks AB, the Swedish match company. The outbreak of World War I provided his perfect opening. As European governments found their treasuries depleted by war, Kreuger arrived with capital. He pioneered a model that became known as the Kreuger trade, extending long-term, low-interest loans to cash-strapped governments in exchange for exclusive long-term monopolies over match production and sales within their borders. This was a form of bundling strategy, exchanging financial resources for industrial monopoly rights, what today might be called a structured financing arrangement. The massive funds advanced to these sovereign states were not derived from match profits. Instead, they were raised through bond and equity issuances underwritten by major financial institutions on both sides of the Atlantic: Lee, Higginson and Company in New York, and Stockholm's Enskilda Bank in Sweden. Kreuger had constructed an elegant capital cycle, issuing bonds in capital markets to raise funds, using those funds to provide loans to governments, securing match monopolies in return, then using those monopolies as collateral to issue more bonds, and repeating the cycle. From a financial perspective, this was an early form of securitization, discounting future monopoly profits to fund current expansion. Kreuger was effectively using leveraged acquisitions to continuously absorb match markets across the world. Banks packaged these bonds, secured by government-granted monopolies, as prime assets and marketed them to investors hungry for stable yields. Kreuger then leveraged these same monopoly rights as collateral to issue further high-yield bonds in the capital markets of New York and London. The involvement of elite financial institutions itself gilded Kreuger with an aura of safety and reliability. The endorsement of established bankers sent a powerful signal to the market. This Swede's business model had undergone rigorous due diligence and was trustworthy. This created what in finance is known as the certification effect, where the backing of reputable institutions adds value in itself. This, in turn, attracted a flood of retail investors, trust funds, and insurance companies, completing a flawless capital cycle. This financial engineering operated with the precision of interlocking gears, propelling his empire into a phase of explosive expansion. From a financial structure perspective, Kreuger's empire was built on high leverage. He used borrowed money to purchase assets, then used those assets as collateral to borrow more. This model is known in finance as a debt spiral, which can be self-reinforcing when asset prices rise, but rapidly reverses when asset prices fall or financing conditions tighten. By 1925, Kreuger's match empire spanned 35 countries across 4 continents, controlling over 60% of global match production through more than 150 factories and employing over 100,000 workers. In modern business terms, this was a vertically integrated global monopoly, comparable in market dominance to today's Apple or Google. On Wall Street, he was revered as a business genius. His company's stock became a must-have in every investment portfolio. The press lauded him as the coolest, shrewdest businessman in the world. His empire appeared to rest on two seemingly unshakable pillars: the profits from technological monopoly and the boundless trust of global capital markets. Yet beneath this glittering facade, fissures were spreading silently. First, technology itself was rendering his product obsolete. The rise of lighters and electric ignition devices heralded the twilight of the match, once considered an eternal necessity. This was a classic case of technological disruption risk. When a new technology emerges and replaces an old one, even the most powerful monopoly can lose its value overnight. Think of Kodak film replaced by digital cameras or Nokia phones replaced by smartphones. Kreuger's match empire faced the same fate. Even more fatal was the empire's financial structure. To sustain elevated share prices and service the relentless interest payments on his bonds, Kreuger needed a continuous stream of new national monopolies. This meant he had to keep expanding just to service existing debt. In finance, this is known as Ponzi finance, using new borrowings to pay interest on old debt rather than relying on operating cash flow. The debt snowball grew inexorably. The entire system gradually devolved into a Ponzi-like cycle, perpetually dependent on fresh capital injections to sustain itself. Kreuger's balance sheet exhibited a classic maturity mismatch. He used short-term debt to support long-term assets, a structure that could function in normal financing conditions but would trigger a liquidity crisis when credit tightened. When genuine growth could no longer keep pace with capital's expectations, fraud began its insidious creep. In early 1929, after failing to secure the anticipated monopoly concession from the Italian government, Kreuger crossed his Rubicon. He orchestrated the forgery of $100 million in Italian government bonds, complete with meticulously fabricated Ministry of Finance documents and official seals. He even arranged for actors to impersonate Italian officials in meetings with bankers, securing massive loans from American institutions using these forged instruments as collateral. The sheer audacity of this scheme continues to astonish financial historians to this day. From a financial crime perspective, Kreuger's actions constituted classic securities fraud. He not only forged the bonds themselves, but also forged the underlying asset supporting their value, government credit. Under modern financial regulatory frameworks, such conduct would face severe criminal prosecution and civil liability. Kreuger's willingness to take such enormous risk stemmed from moral hazard. He was betting on his too-big-to-fail status, betting on the blind trust of banks and markets. He believed that as long as the empire continued expanding, no one would bother to verify the authenticity of those bonds. In October 1929, the Wall Street crash struck like a tsunami, stripping away every veneer. The market's vertiginous descent triggered a chain reaction as investors holding Kreuger's stocks and bonds rushed to dump their holdings. From a financial analysis perspective, the 1929 crash was a classic systemic risk event. Excessive leverage, asset bubbles, credit expansion, all these factors combined to eventually cause the market to collapse. Kreuger's empire was particularly vulnerable in this crisis because he was overly dependent on external financing and lacked adequate equity buffers. Banks, themselves confronting liquidity crises and asset depreciation, moved swiftly to tighten credit and call in loans. This was a fatal blow to an empire so dependent on borrowing to repay. The very institutions that had so generously supplied fuel were now draining the tank dry. In finance, this phenomenon is known as a credit crunch. When banks begin calling in loans, borrowers are forced either to sell assets or face default. In a desperate bid to salvage his dominion, Kreuger deployed his final financial maneuvers. He orchestrated a merger between Swedish Match and its American competitor, Diamond Match Company, creating the colossal International Match Corporation. He attempted to issue new debt to retire old obligations. This maneuver is known in finance as debt restructuring, attempting to extend maturities or reduce interest burdens through mergers or new issuances. But these were merely delaying an inevitable reckoning. By March 1932, the financial pressures on Kreuger's empire had become immense. Its labyrinthine corporate structure and mysterious assets aroused deepening suspicion among certain auditors and creditor banks. In finance, such complex corporate structures are known as related party transaction networks. By establishing multiple subsidiaries, holding companies, and offshore entities, A corporation can conceal its true financial condition, shifting debt and risk off the balance sheet. This was precisely the technique used by Enron in 2001, and Kreuger had perfected it in the 1920s. During an audit of the empire's core assets, serious questions were raised regarding the authenticity of those purported Italian government bonds. Faced with formal inquiries, the Italian government, after reviewing its records, officially denied ever issuing such bonds. This official statement provided the ultimate, irrefutable proof that shattered the facade. Simultaneously, the audit uncovered hundreds of millions in unexplained assets, and revelations emerged of his clandestine fund transfers to Switzerland. From a modern financial regulatory perspective, Kreuger's conduct involved multiple layers of illegality: accounting fraud, asset shifting, cross-border tax evasion. On March 12, 1932, in a luxurious apartment near the Avenue des Champs-Élysées in Paris, Ivar Kreuger straightened his suit, raised a pistol, and ended his life. Scattered around him lay the forged bond certificates and a brief, enigmatic note: "My affairs are too complicated to explain." His death triggered a global financial earthquake. Shares of Swedish Match plummeted 95% in a single day. His bonds became worthless. His stock was virtually wiped out. Financial institutions across Europe and America suffered catastrophic losses. Some teetered on the brink of insolvency. The Swedish government was forced to intervene urgently, restructuring its banking system to avert a complete financial meltdown. This event directly spurred the birth of modern financial regulation. The United States Congress subsequently passed the Securities Act of 1933 and the Securities Exchange Act of 1934, establishing the U.S. Securities and Exchange Commission. Its core principles, disclosure, fraud prevention, and investor protection, remain the cornerstones of global securities regulation to this day. The collapse of Kreuger's empire was far from an isolated incident. It stands as a mirror reflecting a script endlessly reenacted in the annals of finance. From tulip mania to the South Sea bubble, from the fall of Lehman Brothers to the valuation mirages of unicorn startups. Every bubble drapes itself in the mantle of "this time it's different." Yet at its core, the driver remains unchanged: humanity's collective pursuit of the elusive promise of wealth. A match burns from ignition to extinction in mere seconds. Kreuger's empire rose and collapsed in just over 2 decades. He lit the world with a single match and burned himself down with a single bond. The factories that once spanned 4 continents, the financial innovations once hailed as miracles on Wall Street, the loan agreements that European governments once eagerly sought, all ultimately became footnotes to a grand fraud. Kreuger's story is far more than the fall of a swindler. It is a parable about how leverage amplifies ambition, how trust can be exquisitely packaged, and how an entire era can collectively lose its sight. When bankers treated forged Italian bonds as prime assets, when the press hailed him as the coolest, shrewdest businessman in the world, when investors bet their life savings on a man who sold matches, no one paused to ask, is any of this real? Nearly a century after his death, the same script continues to play out in capital markets. People chase wealth myths, believe that this time it's different, and then, when the bubble bursts, realize that nothing has changed. Kreuger left behind not matches, but a mirror. Every time we are captivated by a story, drawn in by a genius, hypnotized by a myth, this mirror reflects our own greed and blind faith. Subscribe to Finance Traveler. We trace the flow of capital across centuries and help you navigate the future with clarity.